Tesla used their stock split to nearly double in market capitalization and bring Elon Musk everything he ever wanted, except for his German gigafactory and getting to space before Branson and Bezos. Apple used their stock split to pack 2 years of market capitalization growth into 6 months. During the process, they became the world's largest listed company again, beating out all challengers to retake the mantle. Additionally, Apple took the time to kick Epic Games out of the App Store. Nvidia has skyrocketed since announcing their stock split and now completing it. Many say the deal with ARM is not yet baked in, which means where could the stock go from here if that deal completes? Today I want to look at companies that may be splitting their stock in the near future and why they may and why they may not. Alphabet, the parent company of Google, is in line for a stock split if we just look at the stock price. Google, as you may know, is the owner of YouTube, where you may be watching this video today. Google is also related to such things as Google Search, Google Docs, Google Cloud, the G Suite, Google Maps, Android, and on and on and on. Google X. In 2014, instead of just splitting their stock and giving more shares out to their current investors, they issued a new class of stock, a class with no voting rights. This has gone on to become quite a theme in the tech world in the sense that the original owners seek to maintain control through voting rights. Google is currently sitting at a market capitalization around $1.8 trillion. Let's examine the case for Google splitting their stock. If Google were to split their stock, they could split their Class C stock in order to create a distinction between Class A stock over here and the Class C stock over here, where they have a Class A trading around $2,700 per share. They could do 5 for 1 and trade their Class C at around $500 per share. This allowed the two classes of shares from Google to be easily distinguished. Additionally, if they got a little more aggressive with their stock split, they might be able to bring the price down far enough to make themselves an attractive company for the Dow Jones. The Dow Jones, as a price-weighted index, doesn't like to have huge share price outliers. As a high-priced stock, Google would also be able to avoid what is known as tall poppy syndrome, where when everybody looks at the share prices, Google's always at the top of the list. This applies generally when regulators are thinking, oh, these tech stocks are very expensive, we need to do something about that. First, stock splits have no value, period. They do not change anything fundamentally. Second, they will no longer stand out. If their share price is the same as everybody else's, they're just gonna look like another normal company and not Google. Third, their management and their board just won't do it. It just won't happen. Hi, I'm Jonathan. I bring you the marketing context through the lens of believability so you can save time, trade and invest your way, and make money. Amazon is a company you may have heard about. They operate in 3 different segments. They operate in North America, International, and Amazon Web Services. Amazon went public at $18 per share, or after the 3 splits that Amazon has undergone, $1.50 per share. Amazon, as you may be familiar with, sells everything. They also have a very high stock price. Amazon's stock price is over $3,000 a share. They are a tall poppy. They are one of the tallest poppies in the flower garden. Their share price is at the top of almost every list. Amazon has split their stock 3 times in the past. In 1998, again in 1998, and then in 1999. All before 2000 and the tech crash. Apparently Jeff decided after this that he was no longer splitting the stock. What is the case for splitting the stock? If regulators get upset with companies, the first ones they're looking at is the ones with the highest stock prices, the ones that have the biggest numbers and the most digits in their prices. Additionally, Jeff left Amazon. He moved on to go to space and to pursue other ambitions and other passions or hobbies. That means there's somebody new running the company instead of Jeff. A case against Amazon splitting their stock is that, of course, it has no meaning. There's no value added. Additionally, the replacement for Jeff is, of course, chosen by Jeff and therefore is unlikely to do something so dramatic so fast and such a dramatic change of course from what Jeff has been doing the last 22 years. Finally, unlike Google, which may be interesting for the Dow Jones Industrial Average, Amazon is a bit too diversified and therefore is probably not that interesting for the Dow Jones. So if they split, they might not join the Dow anyways. It just won't happen. If you're enjoying this content, I would ask that you help me out by smashing that like button so that YouTube can get this video out to a wider audience. Chipotle is the next company I want to tell you could be splitting their stock. Chipotle makes burritos, they make tacos, they make burrito bowls. They make lots of different Mexican-themed food items. Chipotle has been dominant throughout the last years, and their stock price has been growing and growing and growing. Chipotle has never split their stock a single time until today, so why not start now? What is the case for splitting the stock? The first thing on the list is that liquidity. Chipotle is quite illiquid, especially for a company of such size, around $50 billion in market cap. The second reason is that people could say the price is too high and therefore it's not attractive for investors. There's not many investors that can actually buy the stock. Now the case against Chipotle splitting the stock. They've never split the stock before. Why would they start now? Why would they take the time now to do something that has no meaning? They've been doing well so far. Why do they need a stock? And that's right. The second reason is that it doesn't matter. There's no actual change to the fundamentals. There is no change to be won from splitting the stock. It just won't happen. Let's go through this one quickly, as the fourth case that I have for you doesn't look any better or any more likely. Berkshire Hathaway has a share price that is just simply high. It has 6 digits in its share price. A couple things about Berkshire Hathaway is Warren Buffett, Charlie Munger, Geico. Since it's Buffett's company, they've not split their stock. They do, however, have multiple classes of stock. The classes of stock also dole out the voting rights. This means that the Berkshire A is very high priced and Berkshire B is much lower priced. Makes it seem affordable to those investors. What would be the case for splitting the stock? Well, they would lower the price. They would improve liquidity. They would no longer be at the top of everybody's list of who should split their stock. The case against Berkshire Hathaway splitting the stock is, of course, Warren Buffett again. It just won't happen. Who's going to split their stock next? Let me know in the comments down below which company you would like to see split their stock. Is it one of the 4 I mentioned today, or is it somebody else? That's all I have for you today. Jonathan out.